Yeah. How is we talked about this on Twitter a while ago? How is the issue that we're talking about, the elasticity issue that index funds create? How is that distinct from market efficiency?
Um, well, so this is actually a really interesting dynamic, right? Because this is one of those things where the academic definition can really pollute the underlying information set, right? So the academic definition of efficiency is effectively how much of the price change can be explained by the release of fundamental events, right? So information is released, the price changes. If the price changes a lot, then actually the market is theoretically quite efficient, right? And if the market doesn't change or if the security doesn't change in a substantive way different from the market, in other words, you need to think about the behavior of a security as being idiosyncratic in its relation to things like an earnings release and systematic in its relation to behavior with the market.
Hmm.
And so perversely, the definition of efficiency is when there's not information released, it behaves very much like the market. When information is released, it behaves very differently than the market, right? And so the irony is that by making securities less elastic, more inelastic, right? You're actually increasing the responsiveness to those fundamental events, which can lead to the confusing articulation that the markets are becoming more efficient,
Hmm.
right? Things that we look for, things like post earnings announcement drift, are one of the metrics that are used to measure efficiency. Well, those are diminished if the reaction to an earnings report is the stock rises 100%, right? The proportion of movement that's tied to post earnings announcement drift becomes smaller and smaller. Right now, most people are beginning to wake up to this and say, wait a second, it's not at all efficient for the stock price to rise 50% on a $1 trillion market capitalization on an earnings report. Clearly, there's something wrong with the efficiency in terms of information diffusion that's going on. Most people are starting to wake up to that. Most people are starting to recognize that it's not efficient for a company to triple or quadruple in its price post bankruptcy announcement,
Right.
right? So, like, we're starting to actually say, hey, wait a second, that's a stupid definition, even if I understand why you arrived at it.
Hmm.
So now we're
Yeah.
actually starting to recognize that markets are becoming less efficient, even as that elasticity is leading to many of the academic measures of efficiency to be like, hey, there's nothing's ever been better.
Hmm. Man, super interesting. Um, One of the other big measures is active manager performance. Uh, how does this situation affect the ability of active managers to beat the market?
Well, so perversely, what it does is it creates a drift in the marketplace that penalizes holding cash or being quote unquote safe, right? Maintaining the optionality of cash. But it also perversely corrupts measures like the Sharpe ratio or alpha in its behavior. And so, again, jumping to a slide, and this one has to be a little bit interactive. I apologize to your listeners. If you jump to slide 25 in my deck, this is titled When Time Becomes a Proxy for Passive Penetration, Vanishes for Active Management. And what I'm pointing out here is that the historical model of how stock prices behave or how markets behave is that there is a central tendency, equities return 8% a year, and then there's cyclical variation around that. When you introduce something like passive, this is the pale blue line, the convex curve that you see. When you introduce something like passive that pushes valuations up over time, it actually changes that underlying return function from a flat line to a convex line, right? Now, this is where it gets really tricky, and I apologize for your listeners that there is math involved, right? The solution sets that we use in finance, we're all very good at math, right? But alpha is actually just the intercept on a linear equation. The behavior of your portfolio is equal to its beta times the market return plus some idiosyncratic measure we call alpha. Y equals mx plus b, right? If you use a linear solution to a curved surface, over time, mechanically, your alphas get pushed lower, right? It's just math. And it's a
Hmm.
function of the fact that we're really not as good at math as we like to talk about being. right? We're just using the wrong metrics. And so then if you flip to the next slide, you can actually see the impact that this has. The theoretical model, you're looking at alpha in this context, and the impact of passive is identical to the empirical data.
So alpha's going down more than usual.
Because of the growth of passive. It's not because active managers have a harder job or because there's fewer idiots out there, et cetera. There's plenty of idiots. Just look at GameStop, right? But what we're actually experiencing is a market that is being distorted from the growth of passive. As that becomes larger over time, it creates this exponential curve of rising valuations. That in turn forces mechanically the alphas lower for active managers, which causes us to fire the active managers because they're idiots and replace them with the oh so efficient passive investing, which further exacerbates the problem.
Man. So active management's getting harder as indexing grows, harder to generate alpha, which
Right,
is
the
what
exact
investors.
opposite of what most people think.